Hey, Dan Passarelli here. How are you feeling today? I hope you're feeling great. I'm feeling great. You know why? Because we have got a lot of great stuff to talk about. Today, we are going to talk about exiting options positions for maximum profit. Now, I want to make sure you can hear me. Please go and hit that questions box for me or chat box, whatever it is, and give me a big old yes if you can hear me. Will you please do that? Give me a big old yes if you can hear me. I know there's a little bit of a delay. There we go. Thank you, Greg. I appreciate your feedback. Awesomeness. All right. Now, before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you're not prepared to lose. And this is not personal advice. Without knowing your situation, I can't do that. Today, I am providing you with general and good trading information. So, for those of you who don't know me yet, it's great to meet you. My name is Dan Passarelli. I am an author of two of the top option trading books, and I'm a trader. I'm looking at the market, trading the market every day. And I've been doing that for years and years and years. Used to trade down in the pits on the floor of the Chicago Board Options Exchange and Chicago Board of Trade for that matter. And I am the founder of Market Taker Mentoring, which is the leader in option trader education. And I collaborate with a lot of good people in the option trading industry, everyone from platform developers to exchanges all around the world to the top options friendly brokers like Firstrade, for example. And I'm a family man, married to my wife, Kathleen, who those of you who are market taker uh, student traders, part of our family, know Kathleen. She runs operations for us and my two adult children. And I do some fun stuff too, besides trading. Trading's fun, but I'm a runner, I'm a foodie, traveler, been all over the world, and a musician. So, enough about me. Let's talk about you, the important person in the room. You are about to hear about how to exit trades for maximum profit. But before you do, what I'd like you to do is go to markettaker.com. It's market as in stock market, taker as in take what is rightfully yours, two T's in a row. That second T is for theta, by the way. Markettaker.com. And then you can just go up to the top right, click on join free. And we have lots of options, courses, and ebooks, and a free chat room, free right now anyway, that you can join for free and be part of. Okay, let's talk about exiting option positions for maximum profit. We're going to talk about planning our exits, really important. We're going to talk about basic long option risk elimination play, rolling into a debit spread, rolling into a butterfly, rolling into a condor. Oh my gosh, there's so many things we have to talk about here today. The last thing we have to talk about today is your questions. I'm going to hold questions. You can pop in questions during the presentation if you want. If it's not something we're talking about right then and there, I might hold it till closer to the end. But I welcome your questions. I am here for you. That is my raison d'etre for the next hour. All right, planning exits. So this is what I call the MTM trading path, as in market taker mentoring, trading path. The story behind this is when I first started teaching options, one of the first times I was teaching a class, someone said, well, Dan, what are the steps that I need to take to make a trade? And I just thought that was a silly question. I was like, well, you just trade. Because when I was standing down in the pits on the trading floor, the broker would come in and say, hey, what's your market on this? I'd say, oh, I'm, 3-bid at 4. And he'd say, buy him. I'd say sold. And the whole trade was over. That was it. And I didn't really realize that at that point, I had many years of experience and training. And I went through all these steps, but I was a professional and I was able to just basically do all these in a split second. But for people who didn't have training and didn't work on the floor of the exchange or anything, you need that training. And so you need these steps broken out. So these are those steps. And by the way, these are for any type of trade. That's why they're general, right? Because there's sub-steps under all these, and the sub-steps that I'd use for trading a credit spread are different than the sub-steps that I would use for a covered call, which are different than the sub-steps I would use for buying a straddle. So these are general enough to fit every single options position, every single type of risk tolerance, capitalization, trader personality, et cetera, et cetera. But as long as you have this general list, you're much less likely to miss some important bit of analysis. So first, we observe and we discover opportunities. And that could be using a scanner, that could be using whatever. We analyze the technicals, analyze the news/fundamentals, analyze volatility, state the forecast, select the strategy, and all that. We've done many, many webinars with Firstrade on those topics. Today, we're going to talk about the other side of it, planning the exits, executing the trade, monitoring the position, adjusting if necessary, exiting the trade in the postmortem. But we're gonna fine tune a little bit though. We're going to be very, very specific and talk more about planning the exits and actually exiting the trade. Now, monitoring and adjusting kind of also play in there, but this is our plan. So, exits and following the plan. Rule number 1 is follow the plan. Actually, there's a rule like 0.9 that comes before rule number 1, follow the plan. Can anybody take a guess what that rule is? What is rule number 1 for exits and following the plan before actually follow the plan? Anybody want to take a stab at it? How about have a plan? Right? I started market taker mentoring in 2008. I have trained over 50,000 traders. It's probably so many more by now. That was the last time I tried to calculate it. In over 50 countries. And the number one reason why traders fail, you have any idea what that is? It's that they don't have a plan. We need to have a plan. And then there's no point in having a plan unless we follow that plan. If you don't follow it, what is the point in even having it? Now, there's a saying, and it goes kind of like this. The enemy seldom agrees with your plan. So there are some times when we have to address rule number 2, and that is, well, change the plan if you have to. But it's if you have to. We only change our plan when it's necessary. If the premise of the trade changes, for example, We put on a credit spread, a call credit spread, because we have solid resistance above. And we get through resistance. Well, actually, if that happened, we would probably just be following our plan. But if there's some reason that gives us a different idea of the premise of the trade, that the original thesis is null and void, we might have to make some changes. That would be if market conditions change, right? Brand new news comes out. We figured maybe the stock wasn't going to go over 100 because there was strong resistance at 100. And there's a takeover announced, and the takeover price is $103, and it gaps up to 101. Okay, now we have a completely new scenario, a black swan event, something that we couldn't have anticipated in our original plan. Now, that being said, we know that black swans happen time to time. If you're not familiar with what a black swan event is, it's an event that is highly unexpected, like a 6 sigma move, some people would call that. But from that point forward, everything is kind of different as a result of it. We know that these so-called black swan events happen, so we factor in to all of our plans, hey, a black swan can happen, but the definition of a black swan is something that you can't predict. So we don't know exactly what that event is. It would have to be a true black swan event for market conditions to actually change enough that the entire premise of our trade changes and we have to rethink it. Now, all that being said, one of the big challenges here is knowing yourself. Trading is not man versus market. It's not. You know what it is? It's man versus himself, or woman versus herself, for that matter. It's you battling the gray matter in your own cranium. Psychology. And so it's very easy to come up with a plan that makes a lot of sense, and then the stock goes against you, and instead of following that plan, you say, well, I don't know, kind of looks like it might come back because I want it to come back, right? That's not following the plan. That's letting the loss get in your head and having hope or fear or greed mess up your following the plan. Now, let's talk a little bit more about the plan. It's never just a plan. It's two plans. Because what are the two things? Okay, right now, I want someone to answer this. And here's what we're going to do. We're going to have a little contest here. Okay? Whoever can answer this first is the winner of the contest, and you're going to get a mystery gift. You don't know what it is, but you're going to get a gift. So here's what the question is. Are you ready? First of all, are you ready? Give me a yes in the questions box if you're ready. Yeah. Aslam's always ready. Aslam is like Johnny on the spot, on top of this thing. Okay. Goncalo, yeah, is ready. Ted is ready. Ted's not messing around today, is he? No, Ted's not messing around. Chris is ready. Chris is ready. Marie is ready. Marie, you come to our presentations here, right? Yeah, unless it's a different Marie. Marie's always ready. Stephanie's ready. Prince is ready. Tanachi, I'm sorry, I totally probably mispronounced that. I apologize, but is ready, right? Greg is ready. Winkle is ready. Okay. Everybody's ready. David's ready. Okay. What are, now use few words so you can type fast if you want to win this thing. What are the two outcomes that can happen to any trade? What are the two outcomes that can happen to any trade? 1, 2, 3, go. Hit that questions box. Boom. Didn't I say Greg is ready? Greg is getting ready. Gain or a loss. That's it. Everybody else, you guys were quick, but not as quick as Greg. Not as quick as Greg. So, yeah, Greg got it. But Aslam and Goncalo and Winkle and Chris, you guys are great also. You had the right answer. You just weren't quick enough. So, David, here, I'm going to take a screenshot here. David, send me an email at dan@markettaker.com. And I will, oh, no, not David. Greg, sorry. Greg, send me an email at dan@markettaker.com so that I have your email and correspond with you. And I'm going to get you the free mystery gift. So, okay. You can win or you can lose, right? You don't know which one it's going to be. You do realize that even the best traders in the world still have losing trades. It's not about winning on every trade. I mean, look, if I could give you a trade that would win 99% of the time, would you want me to tell you what that trade is? And would you absolutely start following and trading that trade today? Winkle says, yes, please. Well, there's more. There's more to that. What if every time you win, 99 times out of 100, you win a penny, and every time you lose $10,000? Do you still want me to tell you what that is? And are you still going to blindly just start following it today? I think that answer is no. Right. Exactly, David. That answer is no. Because it's just not good risk reward. Our goal isn't to make a couple of trades in our lifetime and retire. I mean, it'd be wonderful if it worked that way, but it doesn't. It's to make hundreds of trades throughout our career and grow that equity curve in an exponential way, right? So if you have a situation where you win 99 times out of 100, that means you're going to lose one time out of 100. And if you make more than 100 trades, you're going to have a losing trade statistically. So we have to plan for this. And by the way, there are some excellent, highly profitable traders who have way more losing trades than winning trades. Someone like Nicholas Nassim Taleb, who, well, incidentally wrote the book, The Black Swan, would have more losing trades than winning trades, but the losers were, he'd be losing pennies and making thousands, just the other way around. So we always have to take into account, what will I do if the trade is profitable? If it goes the way that my forecast or thesis dictates, what will I do? Where will I take my profit? Because deciding where you take your profit is just as important as it is where you put your stop loss. I have seen so many times when a trader would put on a trade, have a solid, forecast, really smart. The trade works out, and he or she doesn't do anything about the trade. And all of a sudden, next thing you know, it turns around and goes into losing territory, and the winner becomes a loser. Has that ever happened to you? Yes. The answer is yes, unless you're brand new at this. Or unless you're highly disciplined and you are very in tune to what I'm saying about having a plan and got in tune before you started trading. So we need to set a profit target always. So we're going to talk a lot more about that in a second. That doesn't necessarily have to be overly simplistic. But we also have to have a plan to take our losses, because if the trade goes against you, you don't want to hit your maximum loss. Sometimes with option trading, maximum losses can be infinite. I've never seen someone lose infinite money, but I've seen people lose a lot of money and make a lot of money. I've never seen an infinite profit for that matter either. So we always need a plan for both a profit or a loss. Now, all that being said, we might exit the trade early, which might be part of our plan, or it might be an audible we have to call, or we might adjust the trade, which is changing the trade, which also can be part of our plan, or can be an audible we call. More often than not, part of our plan. One thing I like to do is to scale out of trades. When there's uncertainty of when to exit, and by the way, this is a thought that is ideally in your head as soon as you make the trade, as soon as you get into the trade, you're planning your exit right then and there, or maybe even before you get in the trade, you're planning your exit. But if you're not really sure, hey, should I take profit at 50% on this, or should I hold out for 80%? Well, I'm not really sure. Well, one of the things I like to do is to sell half or a third at a nice conservative profit. If I'm deciding between 50% and 80%, I'll sell half of it at 50%. And maybe the next tranche at a better price at 80%. In fact, I like to be very conservative on the first tranche. Something like a debit spread, I might take 20, 25% profit on the first half or the first third, and then get better profit on that. If I take a 25% profit on the first half, if you think about it, let's say I paid $1 for the spread and I sell it at $1. I sell half of it at $1.25. Well, that's like owning the other half at just 75 cents. It lowers my break-even point, right? You see that logic? So now what I have done is I've increased my chances of winning. And sometimes if my plan is to sell the first half at a 25% profit on this debit spread and the second half at 40% profit, sometimes I never get to 40% profit, maybe even half the time. I don't know, probably not half the time, and if I don't get there, that's okay. I'll wait it out. I'll wait a day or 2 days or 3 days. And sometimes, I have to sell the second tranche at, 22% profit. Okay. If I didn't take that first half at 25% profit, I'd have a lower profit. I have a lower profit than if I just held out for the 40%, but you have less of it. If you think of your P&L as sort of a bell curve, you have less of a chance of getting 40% profits than 25% profits. So you end up with more winners. What you're really doing is smoothing out the volatility of your success, right? Like, wow, I have, these big winners, 32% on average. But geez, I've got a lot of losers here too. If you do this, if you scale out, you end up with a much higher percentage of winners with, smaller profit overall. In the end, this can be very, very effective for smoothing out your volatility while growing your equity curve. All right. Next thing I want to talk about is adjusting. So, you probably heard the word adjusting before. If you're new to this, if you're experienced, you probably do it all the time. What that means is changing a trade to match a new outlook. Or really just changing a trade, really. The rationale could be to recoup losses, or to gain more profit, or to improve your odds of success. To recoup losses, like let's say you have a call credit spread. You've sold the 100 strike, bought the 102 strike. Okay. You sold it for 45 cents. Okay. Next thing you know, the stock is up over 100. It's at $100.50. Well, you're down money on your credit spread. Okay. That's fine. Is that the end of the world? No. One thing that people do is they roll up a strike, which is basically locking in a loss on that first trade that you made, but having on another trade that you can make money, and you can make more money than what you lost. And we're going to talk more about all these things in a minute. To gain more profit, well, actually, I've got a great example of that. And improving your odds of success, the example I just gave, is a way to improve your odds of success. So let's go through some tactical technique on some of these. This is the basic long option risk elimination play. Let's say I buy 10 50 strike calls at $2 when the stock is at 50 bucks. So at the money options have a delta of what? About 50, right? So if I have a 10 lot, that's like being long 500 shares. Now I've paid $2 a share for this 10 lot. So my total cash outlay is $2,000. Now, scenario, stock rises to 54 bucks, making the call worth $4 per delta. Right? So here's one thing I can do. If my original trade was buying 10 of these calls at $2, total cash outlay of $2,000, now it's doubled in price. What if I sold 5 of those calls at $4? Well, 2 times 10 is $2,000. 5 times 4 is $2,000. So I'm basically taking all my money off the table. It's like sitting at a blackjack table, putting 200 bucks up. You have a hot streak, and now you've got 400 bucks, and your spouse comes by and says, "Hey, honey, looks like you're doing pretty well. Why don't you give me that first $200 to put in my pocket or my purse or whatever, wherever they're going to put it, and play with the house's money?" Now, the house's money is a little bit of a fallacy, but that's a different discussion altogether. But you get the concept. You're putting yourself in a situation where you can make more on the remaining 5 calls, but it's impossible to lose money overall. So that's kind of 2 different ways of looking at it, but you can look at it 2 different ways. Like if you're buying a car, you don't just like look at the side of the car and say, yeah, driver's side of this car looks pretty good, I'll buy it. No, you walk around, you look at it from all angles, different perspectives. Look at it from the inside, right? Well, one way you can look at this trade is I'm locking in a profit, right? Locking in a profit of a couple grand. Or another way to look at it is I'm taking those chips off the table and playing with the house's money. So now overall, I can't lose. Now, the reality of it, and let's get back to that fallacy of playing with the house's money. The reality of it is at this point in time, you are up $2,000. If the stock goes down and is trading at like 40 tomorrow, you'll lose that $2,000 that you're up, but you've already taken 2,000 off the table. So you actually break even, but you're probably going to be angry because that house's money was actually your money. And so you lost it. So this is not like the be all end all, the best case in the world, but this is a very good case. And this is a very good way to handle the situation. And truth be told, you don't necessarily have to double your money to do this. Even if the stock is up $1 and I could take that $2,000 investment and, you know, now the $2,000 investment is worth, you know, not 4,000, but maybe it's worth 2,500. And I can sell half of it for that 25% profit. That'll work too. I didn't take my risk down to zero, but I've taken the remaining half of that position down to, you know, to 25% of the cost basis. All right. Anyway, let's talk about reducing risk and taking profit here. This is another way to look at it. This is sort of an alternative to adjustment one that we just talked about. Instead of looking at it as playing with the house's money or eliminating our overall risk from the beginning of the trade and selling half the position, what we could do is manage the position from a delta perspective. We started out with the 500 delta because these calls were at the money. What I could do is now that the calls are in the money and the delta is bigger than 500, I could sell enough calls to get back to having a 500 delta. In this case, I'd probably sell like 6 or 7 calls, right? Alternative adjustment number 2. I can also roll this into a debit spread. Now, this is a good one. We had a mastermind. We have masterminds every year where we invite some of our top students for a in-person training. It's a very small group, kind of an elite thing for people to really ramp up their learning fast. But at a mastermind, we were trading together, and this is a trade that I made using this exact adjustment, and it worked like a charm. This is rolling into a debit spread. So let's say we're long a call. I can do an adjustment, and this can be a plan from the beginning of the trade, not calling an audible, not changing my plan, but this can literally be my plan, and roll it into a debit call spread. So let's talk about how this works. We use this to leg, again, there's a couple different ways you can look at it. One way to look at it, we use this to leg the debit spread at a more favorable price than initially possible. Now, this, just like the last adjustment, this is an opportunistic adjustment. There are many, 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 many different types of adjustments that we can make. Today, because this class workshop is all on maximizing your profit, these are adjustments that you can make when you have a profitable position. I call those opportunistic trade adjustments. Okay. So let's say I bought one of these 50 strike calls at $2, or it could be a 10 lot or a 5 lot or whatever. It doesn't matter. At that time, the 55 strike calls were 30 cents bid. So I was probably deciding at the time of this trade, when the stock was at $50, should I just buy the 50 calls, or should I reduce my risk and buy the 50 calls and at the same time sell the 55 calls to trade a debit spread? But I probably look at this and say, I'm only taking in 15% of the value of the call I'm buying, and I'm limiting my profit potential by a lot. So it's not worth it to sell the 55 strike calls. I'm just going to buy the 50 calls. Okay. Well, now the stock goes up to $54, right? Just like in the last example, now the 50 calls are worth $4. So sure, I could do the adjustment I did last time, or instead of selling half of them, well, it's a one lot, but instead of selling half of them and taking my money off the table, playing with the house's money, what I can do instead is sell the 55 strike calls, which in this example are trading at $2. They're $2 bid. Now, if I do that, now I've got on my 50-55 debit call spread. I'm just doing what we call legging the trade. Legging the spread is when you trade one of the options now and another one of the options later. So the new trade that I have on now is I own the 50-55 call debit spread at 0. Remember, originally I could have paid $2 for the 50 calls, sold the 55 calls at 30 cents. I could have paid $1.70 for that spread. But instead, because I bought the 50 calls first, and then the stock went up in my direction, which is not always going to happen, I was able to sell the 55 calls for $2, which is exactly what I paid for the 50 strike calls. So now this thing that was worth $1.70, I actually own at 0. It's pretty good, right? So the risk reward of the position at this point is 0. I can't lose money. Now, again, I can't lose. I'm playing with the house's money. So overall, from this point, compared to where I started, or compared with where I started, I have no risk anymore. That said, this spread is worth, it's going to be worth at least $4, right? Probably a little bit more. So I can lose that profit that I have, that house's money, but comparing that with where I started the trade, I've got no more money. I'm playing with the house's money. I did set my maximum potential gain to $5 because that's all the spread can be worth. So there's some tactical considerations here that I need to think about. First of all, this serves a very special purpose. This is not an adjustment that I can always execute. This is an adjustment that I can execute sometimes. Maybe if I make this into my thing and get good at it, I might be able to do something like this 10% of the time. Okay. And usually of that 10% of the time, I'm probably not selling the 55 call at the same price I bought the 50 call. But heck, if when I made the trade, I could have sold the 55 calls at 30 cents, but the stock has gone up enough where I can now sell the 55 calls at $1. I'm still legging into a very, very favorable price for the debit spread. I could have paid $1.70 for it. Now, because I leg it, I own it at $1, less than I could have paid earlier. Now, this idea that you can't always do this is extremely important. There is a cardinal rule. You must like the first trade, the first leg, in this case, the 50 calls, on its own, because you may never get the opportunity to sell that 55 strike call for enough for this to be worth it. Heck, the stock might go down and you might lose money on the 50 call. The stock might go up slowly and all the increases that delta makes for the 55 strike call can be offset by the decreases in theta as time passes. And when stocks go up, volatility tends to go down, so the decreases in vega as well. You might win on that 55 call as it gets more and more in the money, gaining more and more intrinsic value. But the 55 call, it might stay at 30 cents. Or it might get just to 40 cents where you're like, yeah, it's not really worth, it's not really worth it at 40 cents. So you may never get that second leg. So this is an adjustment that you can keep in mind doing if it ultimately goes your way. One of the things that I do is I say, I would do this if there was a lot of very strong resistance at or slightly above 55, and I don't think it's going to go much above 55. This becomes an excellent adjustment. But if I think it can take off a lot more and get to 60, there's no resistance till 60, I probably wouldn't do this. I'd probably do the first adjustment that we talked about. All right, now we talk about rolling into a butterfly. Any questions yet? Any questions yet? No? All right. Now let's talk about rolling into a butterfly. So this is adjusting from a debit spread into a butterfly. This is kind of like a fractal discussion or reverse fractal discussion. We're kind of taking the same idea that we did, but instead of doing it for a single leg, we're doing it for a spread and rolling into a bigger spread. We're going to use this to leg a butterfly at a more favorable price than initially possible in very much the same way we just did with the single long call. This is also an opportunistic trade adjustment to help you maximize your profits. So here's how this works. We have a brand new example here. Holy moly. Okay. This stock is at $61 a share. And we're moderately bullish on this trade. And so, maybe there is some resistance at $65. And so we decide, hey, because there's resistance at $65 a share, instead of just buying the 60 calls and paying X, I'm going to buy the 60 calls for X and sell the 65 calls for Y and pay X minus Y. I'm going to pay something less because I don't think it's going to go above 65 anyway. So I'm okay capping my potential profit. Pay less and can make more if it gets up to 65, even before the adjustment of rolling into a butterfly. So let's say the stock works out perfectly-ish, pretty much just like I thought it was. It rises up to $64.50 over the next day or two. Still have some time until expiration. One of the things I can do is sell the June 65.70 calls credit spread at, in this case, $1.50. So I'm keeping the 60-65 call spread, long the 60 calls, short the 65 calls, and now I'm selling another 65 call and buying the 70 calls. So this is legging into a butterfly. Specifically, I'm long the 60, 65, 70 call butterfly, not iron butterfly, but regular butterfly. And in this example, just to make this very simple to emphasize and maybe even overemphasize my point, we're owning it at zero because we paid $1.50 for the credit spread and we sold the debit spread at $1.50. I have no money in this. I own a butterfly for free. Playing with the house's money. Wasn't there a song, Butterflies Are Free? Butterflies are free to fly. Sorry, I will promise I will never do that again. Okay, so the risk reward here, the max potential loss at this point is zero. I own something that has value for free. In this case, it probably has somewhere at least $4.50, or well, no, it's probably a little bit less than that, but it's probably worth $3 or $3.50, depends on how much time there is until expiration. But I own it for free. Now, the most this can be worth is 65. And remember, there's resistance at 65. I didn't think it's going up above 65. And I don't think it's going to go back down. I think it's probably going to stay around 65 between now and expiration. So this thing that I ultimately own at zero, I'm going to hopefully be able to sell this at pretty close to $5. Probably have to wait until close to expiration because now it's really a theta trade at this point rather than a delta trade. So the tactical considerations are this serves a very special purpose. We cannot always do this. This, this is conceptually exactly like the other trade. So maybe 10% of the time we can do this. And of that 10% of the time, a very small percentage of the time will I actually be able to leg into the butterfly to own it for free. If I paid $1.50 for the debit spread, if when I put that on, I can sell the credit spread at, 40 cents. If I can sell the credit spread later at $1, now I own the butterfly at $1 instead of $1.60. It's still beneficial. I don't have to wait until I can sell the credit spread at the price that I paid for the debit spread. So, cardinal rule here, you got to like that first trade, that debit spread on its own, and not rely on the market rising because it might not ever get to the point where I can sell the credit spread for enough to own the butterfly for cheap enough to make it seem worth it. Next, rolling into a condor. This is adjusting a debit spread into a condor. So this is a very similar adjustment, but I just want to give you some flexibility, give you a different concept of how you can do this. Here we use this to leg the condor at a more favorable price than initially thought possible. This is also an opportunistic trade adjustment. So, scenario, the stock is at $61. We're moderately bullish. We think that the stock can maybe get up to 65. There's some fairly strong resistance there. There's a little bit more resistance, up at 70, we'll say. So, we buy the spread we buy the 60-65 call debit spread for $1.50. And boom, the stock rises up through the fairly strong resistance. Now, at this point, we're like, wow, I didn't think it would get through 65. Hey, my call debit spread is still a winner. I'm okay with that. I'd like to be able to squeeze out a little bit more here. I'm not going to like buy the 65 call back because I don't think it's going to get through 70. So what do I do? Well, I could sell the June 70.75 call credit spread for whatever price. $1.50, maybe. That would be great. $1, hey, that would still be pretty great. And let's look at why. Because if I sell it for $1.50 to overemphasize my point again, now I'm long the 60, 65, 70, 75 call condor for free. Long the 60 calls, short the 65 calls, short the 70 calls, long the 75 calls. Where do I need the stock to be at expiration to maximize my profit on my condor? Anybody know? Anybody know? 70 would be fine, but there's a broader range. Where do I need that stock to be? What's the range? Yeah, I mean, you're right. 70 would work. Anywhere between, oh, there you go, Aslam. Thank you. Anywhere between 65 and 70, which is where we are now. Stock's at 67 bucks. So now in this, made up example, I own this condor, something that can be worth $5. As long as it's between 65 and 70 at expiration, it can be worth $5 and I own it for free. And the stock's already sitting there right now as we speak. So I've got a head start in making $5. Now, I always like to close these things before expiration and not get the maximum profit. But still, even if I sold it at 470, it's a nice little adjustment. So same caveats here. This serves a very special purpose. We can't always execute this, and the cardinal rule, we got to like the first leg on its own and not rely on the market rising. And again, we don't have to sell the 70.75 credit spread at $1.50. Basically, as long as they're selling it for more than we could have when we first put on the trade, we're legging a favorable trade. Caleb says, I need help assessing my Firstrade account. Yeah. Hopefully some of the good people here at Firstrade are seeing this comment and can help you. Obviously, I'm a guest speaker and I'm in the process of doing a workshop, so I can't help you. I don't actually even work for Firstrade. So make sure, hopefully somebody is hearing that and they can help you. Okay. Another thought here. When would I do the butterfly roll? When would I do the condor roll? Well, truth be told, first of all, you probably can't actually do the condor for zero. Just have that in mind. But you can still leg it for a favorable price. And with the butterfly, there's 3 strikes. We need, like, if you can imagine what a butterfly looks like, butterfly P&L diagram, it's got to be at that middle strike to maximize the profit, which, is a tall order. I mean, it's almost never actually at the strike, but if it's close to the strike, that's good. So the condor, you got a $5 range. There's a lot more wiggle room with this. So you're much more likely to reach your maximum profit, though, well, in this case, the maximum profit is still the same. So when do you use which? Well, I would use the butterfly roll when the stock is near that short strike in the initial debit spread. Maybe it didn't quite make it there, but it's about there. Like in my example, it went up to 64.50 and the short strike is 65. That would be when I would choose the butterfly. With the condor, I would use it when the stock moved a little bit above the short strike. Hey, we're already above it. You know, let's use that one, because if it keeps going a little bit higher, that's okay. All right. Do we have any final questions? That was some pretty good information there, I think. Using these adjustments can help you maximize your profits in a whole number of different scenarios. Again, this is for profit maximizing. In hindsight, I didn't really think about it, but I can probably do a class on adjusting losing trades to help reverse losses. So if you like what you're hearing here, I will see you next week. I'd love for you to give me, or give Firstrade some feedback on what you think. Hopefully it's positive feedback. Someone says, why not just close the long side and realize the profit, then sell the short side and get more profit? Well, I'm not a big fan of having naked short options on, because then you can turn a profitable trade. Like in this example, if you're long the 60 calls, short the 65 calls, if you take your profit on the 60 calls and just leave the short 65 calls on, well, what if it goes up to, okay. So basically, like for the butterfly roll or condor roll, take your profit on the debit spread and then sell the credit spread. Yeah, it depends on your forecast at the time. I mean, remember, initially you put this trade on because you're bullish. Now we're talking about rolling into a bearish trade, which could make sense if it bounced up against resistance and looks like it's pulling back, looks like resistance is going to hold. That's not necessarily a bad adjustment. And you can actually end up with an even bigger profit at that point, doing it that way. But, that is for yet a different scenario than the ones I talked about. So sure, there's another arrow in your quiver for sure, my friend. All right, everyone. Well, have a great rest of your day. Hope that helped. This is Dan Passarelli. Trade smart, my friends. Anonymous says, I'm brand new at this and the terminology is new to me. Is there a book that you could recommend to get the basics? My books are not really basic, but I'll tell you what, the classes on my website, if you go to markettaker.com, there's a risk analysis class. It's going to be free to you. There's a risk analysis class that you can sign up for, and it covers all this, all the terminology, how to draw the P&L diagrams, the whole shebang. So go to markettaker.com, click join free, and go through the risk analysis course. That'll help you. It doesn't cost you anything. All right. That being said, folks, have a great rest of your day and trade smart.